Three steps to protect your savings and your portfolio in today's inflationary environment. Hello, and welcome back to the ROI Club, the club that's obsessed with the art and science of return on investment. Trying a new format today, so I hope that you enjoy it. We're going to get into it, guys. I'm going to give you three practical things that I want you to think about, things that I myself am implementing, and I'm very glad that I've been doing this over the last 5 years. So stocks are overvalued, inflation is rising, and people are finally starting to really grasp this in their day-to-day life and living expenses. I'm going to walk you through three very basic but very powerful points that I think you're going to get a lot out of, including an update on one of my top positions, New Fortress Energy, that you guys have been asking. I am using new technology today, so we'll see how we go with that. Before I get into it, disclaimer, of course, nothing I say is advice. You need to do your own due diligence and research your personal financial advisor. I am not your personal, nor am I any type of financial advisor. If you enjoy the content, though, please do like and subscribe if you want to see me giving out more and more free content to YouTube. I only have so many hours in the day, and so I must dedicate my hours where they give me the best return. And that's why this is, of course, the ROI channel. So with that being said, happy 2025 to you all. First point I want to make today is that if people notice that their purchasing power is diminishing, and it's natural, then they start to look at places where they can protect their savings or even grow it over time, something that's going to protect us from inflation. The problem is a typical hideout would be stock indexes, but the indices are way overvalued today. And so this leaves little room for error if there's a downturn, given the high valuations and given the fact of where we are macroeconomically and geopolitically, there just doesn't seem to be the same growth drivers that there have been for the last 10, 20, 30, 40 years. And so it's just going to be, I think, very painful for a lot of people. Investors that have been relying on the S&P 500 as a hurdle rate are in for quite a rude shock. I'm going to show you something that has slightly beaten the S&P 500 and required absolutely zero brain work whatsoever. So stay tuned. Investors that have been relying solely on index funds are not only having not outperformed this no-brainer hurdle rate, have also exposed themselves to significant downside risk. And that may not have happened yet. It doesn't mean it can't happen. It doesn't mean it won't happen in the future. So I'm going to share my screen with you guys and talk about the first point. So the first point is indexes. Okay, so let's take a look over just the last 5 years for argument's sake. The S&P, okay, so S&P 500 matched by the SPY index, and the IVE. So people might think, okay, maybe the tech stocks in the S&P 500 have little room for growth or error now, but the value stocks, they're what's going to do well over time. Well, let's compare the pair. First of all, S&P 500, as you can see here, it's done marvelously well over the last 5 years. You're paying 26, nearly 27 times earnings. Okay, so for every dollar of earnings, you're paying nearly 27 times. In anyone's language, that's an awful lot of growth required to justify that. And so without making this video too long, the drivers that have led to this occurring now no longer seem to be in place. They seem to be inflecting and rolling over. So cheap labor through the likes of China and Southeast Asia, with geopolitics starting to unravel between East and West, this theme of reshoring or friendshoring, I don't think we're going to see much more cheap and steadily available labor for the companies that make up the most of the S&P, which are your Apples, your Microsofts, so on and so forth. Higher interest rates or high cost of capital are nearly double the sort of 2-3% at which these companies are used to being able to borrow money. In addition to which, we've now got rising commodity prices or energy prices in terms of the input costs for these particular companies. So that's that aspect. They would be the first few points that I would like to make. I would also, if I can work out how to operate this machinery, I would also like to bring up some other points. So let's go to the value stocks. We thought, well, maybe the value is going to save us here. Value sounds, reasonable, doesn't it? It means that you probably wouldn't be paying quite so much. And if we look at the PE ratio for the iShares 500 value ETF, and this is not something I own nor would own at these prices, but you're still paying 22 times earnings. which to me is quite rich in anyone's language. And so why is that? Well, let's take a look at the holdings and let's see how different that is really compared to an S&P. And as you can see, over a quarter of this thing is in technology. I mean, it's crazy that that's not giving you access to the cheap or value sectors of the index, and it's not giving you broad diversification, very US centric and very literally, as you can see, tech heavy. So you're not getting broad sector diversification. You're not getting a geographical diversification. And so as we come down here, there is an energy company that makes up nearly 2%, and that's ExxonMobil, and they'll do reasonably well in an inflationary environment. But if we look at healthcare, should be okay, single digit returns max, I would expect for healthcare, financial services, maybe thereabouts. We're still buying very mature businesses in very mature markets. They do not have superior business models really, apart from, say, your Visas. And Berkshire Hathaway, of course, would be an exception. But again, Berkshire's at such a size now that it can't deploy capital like it could when it was a smaller corporation. So you're really not getting value, you're not really getting diversification. And I think that you're taking on a lot of risk for a reward that doesn't justify it. So that would be, I guess, a few of the main points that I would like to make for point number one is that indexes are overvalued. What can we use as a hurdle instead? Instead of the S&P 500, which we think is getting pretty frothy, pretty tech heavy, in a rising interest rate environment, a rising inflationary environment, what else could, if I'm earning dollars, my Australian businesses are earning me dollars, businesses priced in US, earning me US dollars, where the hell do I go? That's the next question. And I want to share this with you guys. So if you were in the US and you just took your savings and parked it in gold over the last 5 years, you did better than the value stocks. And you did basically as well as the S&P 500 without anywhere near the risk and without anywhere near the amount of work. You literally didn't have any of the brain work to do. You took your money and you kept it and saved it into gold. Okay. If you go back a little further, obviously, depending on how far this thing goes back, you got quite a bit of catch up to do. But the value stocks did not outperform gold. Okay. We're in, I believe, a new macro environment. And so I think this is going to be really instructive. For someone saving in Australia, your gold has risen against the Aussie dollar 45% over the last 5 years. So for me, when I look at this, I'm looking at gold as a way that I can compound with basically no risk whatsoever. Over the last 12 months, you see what's really outperformed. So we're starting to hit this inflection, and I believe gold will start to outperform over the next few years. I've got to beat this type of performance in gold for me to even worry about entering into the stock market. So there's a simple practical consideration for you. If you're just an average person, you're not a professional investor, you're earning some money, it might be worth taking a decent amount of that savings and put it into something that is in an inflation protection for you. And you don't have to think about it. And it's also outperformed the broad index that is supposed to represent the US stock market. So hopefully that is a big pointer for you. Don't underestimate it just because it's simple. It's something I'm very glad that I have been doing over the past few years. Now, enough said on that. All I want to say is that this is now my new hurdle rate. Whenever I get a new investment idea, I have to be able to justify how that's going to be better than this compound return over time. Okay, that's the hurdle I'm using. I'm not using risk-free rate, government bonds, anything like that. Total rubbish. This is what I now have to justify to myself before I enter into an alternative investment other than the gold. Segment three. Okay, so where do we go from here? We want to have a little bit of exposure to land, gold, and business, as the old philosophy is. What type of businesses should we own in the upcoming environment? So a dearth of capex, particularly in the energy sector. How do I escape that, or how do I profit from that? How do I escape high prices that will result? How do I profit from the very same phenomenon? So New Fortress Energy is one. It's not my favorite, but it is a good idea. People are asking me about it, so I'm going to talk about it. Disclosure, do your own due diligence. Nothing I say here is a recommendation. I'm just giving you my opinion on the company. So NFE continues to lock in about $7 per MMBTU in their margin. So what this is not so much a gas producing company. It is an infrastructure or toll booth company. And they buy gas and they sell gas or they sell electric power and they lock in a margin for many, many years. So whatever happens in the gas prices at either end, these guys have set in locked margins. So they're not exposed to the commodity price inflation in the same way that a regular gas producer would be. So hopefully that makes sense. If you're interested, I have several deep dives, most of which are available for free in my Substack. You can click on the link below and read most of that for free. So why does this matter? Well, overvalued stocks, they rise and they rise, and now they're at this point where they're risking a sharp correction. NFE has been the opposite. So if we take a look, it's had a shocking last 12 months price-wise. It's now starting to correct, and people are realizing the stability of the company, the earnings power, and the income potential. So let's take a look. NFE, New Fortress Energy, has been quite the wild ride in terms of its price action. I'm going to get rid of the rest of it. Okay, so here we are. Over the last rolling 12 months, the stock is down 60%. So what the heck happened here? Company basically has built power plants in PR, in Puerto Rico, and the government then had the right to buy that back at about $350 odd million, if I remember correctly. So they sold the asset, they made some money, but they don't get to book that asset sale on the balance sheet of their accounting standards like you would normally expect. And so this was a bit of a curveball. They then went out of whack in terms of their assets to liability and their debt to income ratio because they couldn't count or account on that asset sale. What that meant, they were technically then breaching some of their debt covenants. Their lenders called in and they had to restructure. So they diluted the float by about a third and they issued and restructured all the debt further out at a much, much higher interest rate, about 11 or 12%. Okay. So be that as it may, those problems in terms of the debt risk is now really out of the way for this company. They've got locked in margins, locked in contracts, and 1.1 to 1.2 billion in backlogged EBITDA over the next few years. So it's trading just a little bit over 2 times the EBITDA at the moment in terms of the price of the whole market cap in terms of what the company will do on an EBITDA basis, and they have such room to grow. So here you can see what the stock was doing and where I believe ultimately it will start to end up once people realize that the risks are really over for this particular company and things are much more stable than what you might think if you were only looking at the price action. If you want a deeper dive into NFE, as I said, subscribe to the Substack. There's free options below the ROI Club, where you'll also get access to exclusive analyses and actionable ideas with the trades that I am making. So that's the summary, guys. Inflation is really kicking off. It's coming into that third nasty leg, which really tends to bite people. Gold's role as inflation protection is holding up and has now become my personal hurdle rate. I suggest that you might like to consider that in your own time and see if that's appropriate for you. Stocks are overvalued. They're not going to be a refuge moving into the future. A lot of people are going to be really hurt and burned by this. And I think that in very select parts of the market, the energy markets, which will benefit, you can have some specific cases of businesses that will outperform and do very well. NFE is just one idea. So thank you for watching, guys. Like and subscribe to the channel. Check out the Substack in the link below. And remember, nothing is advice. Do your own due diligence. I look forward to catching up with you in another episode of the ROI channel. Take care.